So we are Team 7, and we are presenting our work on predicting the stock market using ARMA and BKSSHER method. Historically, it has been a big interest for both traders and investors to predict future stock prices as they can make strategic investments to yield profits in the market. And recently, with the rise of machine learning techniques, predicting future stock prices has become a problem that is somewhat solvable. We believe that by creating our stock price prediction model, we can have a better understanding of how the market is going to turn out in the future. And so our objective was to prove that an effective model can perform well in making future stock price predictions and present a stable investment strategy. So why is stock market prediction important? Well, on the baseline, it is because everyone wants to make more money. And so by predicting the market well, one can minimize his or her loss when investing in the market. Also, by knowing the right time to buy and sell, one can consistently yield higher profit. In the perspective of the companies, it provides them with capital to scale their businesses. There are two camps of analyzing market dynamics: fundamental analysis and technical analysis. Fundamental analysis derives values from qualitative measures like economic conditions, whereas technical analysis derives values from qualitative means by studying past market data. Using the machine learning model listed on the slide, literature tests use of different features to predict the next price. For instance, they use technical indicators listed in the slide. And some literatures also try to use semantic analysis factors, such as news about a certain company. Our work is an application of an existing approach called ARMA, which stands for Autoregressive Moving Average Model. We referenced a study done by Ario et al. That used autoregressive integrated moving average model to predict future stock prices. Unlike the existing study that used the data obtained from the Nigerian stock market, we used 102 companies listed in the NASDAQ 100 index. In order to get NASDAQ 100 index data, we used Yahoo Finance API due to its large historical data set, easy retrieval of data, and also convenience when converting into Panda data frames. The data set obtained from the API included the date, trade volume, high, low, open, closed, and adjusted closing prices of each 102 companies. When implementing our model, we made some assumptions. First, we only study the closing prices of every trading day. Second, we only buy the amount we currently have in our pocket. Third, we leverage a maximum of $1,000 when shorting on a stock. Moreover, there are some assumptions that we made for our data set. First, we considered the adjusted closing price over the closing price. This is because we considered that adjusted closing price is more accurate measure of stock's value. Along with the assumptions, we performed some pre-processing on our data set. We dropped metrics that we don't use and added 12 technical indicators listed in the slide.
Here we are showing two different models that we consider to make making future price prediction. First approach is using an autoregressive moving average model. This is a appropriate model for predicting future price point in a time series data, since the autoregression part of the model let the evolving prediction values to be regressed on its own prior values, and moving average part of the model makes use of the lag moving average to smooth out the time series data. Second approach is using random forest model while reshaping the data through framing a window. So each time step will contain the previous values. And this way, ML model that not necessarily designed to consider data evolving over time steps can be used for the future step prediction. Here we show the overview of our ARMA architecture. We use the data with technical indicators as stated, and we use the ARMA model to predict the closing price after 5 days of current time steps. And predicting the price of immediate future encountered huge error due to the large fluctuation in the daily stock price. So here we predict the price after 5 days. This is how we actually implemented our ARMA and random forest model. We used the Python library to implement the model efficiently, and the slide is showing the codes.
So in a sense, we want to buy at the knees and sell at the shoulders. And we call this method BKSSHER, named in respect for Professor BKSSHER. So let T be the last trading day before we start trading. As described earlier, our ARMA model provides a predicted adjusted closing price of each stocks after T plus 5 days, which is the next last trading day. Then we calculate the percentage difference between adjusted closing price on day T and predicted adjusted closing price on day T plus 5 of each stocks. By using these values as weights on how much we want to invest, we either buy or short when the value is positive or negative, respectively. Then we sell the stock when the price is either higher or lower than our predicted price in the 5-day range. If the situation doesn't happen, we sell on the last trading day.
This is an example outcome from our ARMA model. It is showing that our ARMA model predicts general trends very well. And we're presenting the final results using both models. And as we calculate the prediction accuracy, we consider the prediction was correct if the trend of the predicted ending price matches that of the actual ending price relative to the starting price. And ARMA model is showing high accuracy here. And it let us reliably use our BKSSHER investment strategies to make profit from our investments. And in contrast, the random forest model is showing lower accuracy, causing less reliable investment outcome. And for a final analysis, there is a fundamental limitation due to the assumption made by technical analysis. We assume that the market discounts everything, which means the stock price conveys everything about the company. So the price movements in the market are based on trends, price movements repeat themselves in the market over time. However, when considering fundamental analysis, which places importance on assessing intrinsic value of the stock, such as a company revenue or potential for growth, the assumptions made via technical analysis are nullified. Next are some points that we learned from the studies. We tested ARMA to predict the stock price of all 1 through 5 days futures, and it turns out the model suffers from capturing short-term fluctuations, so we better capture the longer trend. Also, as ARMA naturally regress on the past observation and states that is it performs better than the random forest model.
The key takeaway from this study is that ARMA, in conjunction with the BKSSHER trading strategy, is fairly effective. In the future, we want to consider different data set, models, and explore new features and situations. Thank you.